right, let's get it. Let's get it. Hey, what's going on, family? My name is Tyler.
And it's Daryl checking in with you.
And this is Uncharted Mind, right? The show about life, health, and wealth. I had to wear the shirt today, man. All right, so listen.
Yeah, y'all see it. Y'all see
Hey,
it.
merch coming soon. Merch coming soon, man. Be on the lookout for that. All right, but listen, today's episode, man, is dope, man, because we talk about finances, we talk about, entrepreneurship, and we talk about all things, dealing with money. But, we feel like, we had a conversation off camera. We felt like we haven't really had a ground level conversation of where people should start. You know what I mean? Like the basic knowledge of money, how it works, what's an investment, how to invest, 401ks, IRAs, all that stuff. We're going to get into that today, man, because we got a special guest for y'all, man. Somebody I met just through networking. You know what I mean? He actually rented my truck on Turo, and he told me that he messed up when he did this, man. Hey, dang, he told me that he was going to a business meeting, and I was like, hold on now, black guy,
wide open there,
business, exactly, yeah. black guy, business meeting. And listen, the people know how much I love business, so I had to ask further questions, and when I did that, man, we found synchrony, man. Like we found something coming, we found common ground. And I realized, man, this was somebody I wanted to have in my corner, man. So, without further ado, man, I'm going to go ahead and introduce our guest, the guy who's been in the financial industry for a while, the man, the myth, the legend himself, Mike Williams. What's happening, bro?
Good morning, fellas. Glad to be on here with you guys.
Definitely, man. We're glad to have you.
Appreciate it. Yes, sir.
All right, so, real quick, man, let's go ahead and, introduce yourself to the people. Let the people know who you are and what you're about, man. So just go ahead and give us a quick overview of you and yourself, and let the people know what's up.
Yeah, man. So again, my name is Mike Williams. I've actually been in financing since like 2009, 2010. Been fully licensed since about 2010. Was doing some stuff before that. I'm here from Colorado Springs, right? I've been here since I was about 2 years old. Okay. I grew up out here with a military family, you know what I'm saying? So, yeah, that's about it, man.
Okay.
All right, so did you go to college?
Yeah, I attended college. I didn't finish. I went to
Didn't we all?
Didn't we all? I was about to say all three of us.
Right. Mark checked some college on that box, but I actually had a full ride academic scholarship to University of Northern Colorado, and I was studying political science. And one of the reasons I didn't finish is my dad got real sick, right? So I moved back home, and that's when the financial stuff became a big deal, because he ended up passing away, and I saw a few things that didn't look right to me. So I was like, yo, I need to learn about this. I was like 19 years old at the time, 19, 20. And I was like, I need to learn about this so I can make sure my family is good going forward and my friends are good. And then I fell in love with it. So.
No, that's dope, man. That's dope. And then that's usually where, that's usually where our interests are peaked, man. Like and it's sad to say, but when, something detrimental happened to the family, man, that's usually when we start to build, just like I guess insight on like, okay, this is what we should put to the forefront of our mind. You know what I mean? So man, yeah, it's crazy that we have to go through certain things to see this. But man, I think, hopefully, we can charter the waters and kind of let the people know, okay, well, this podcast is to let you know what you can do or what you can be financially prior to anything, detrimental happening to your family, man. So, all right. So I'm glad you mentioned that, right? So what area, you said you've been in finances for 10, 11 years. What areas would you consider yourself most experienced in?
Really a lot, man. So the good thing is I'm able to do a lot from like actually putting a game plan together for a family or a business. Yeah. So anything from, starting investments, whether that's kids accounts, retirement accounts, emergency funds. I know we're talking about some of that later, to setting up a plan for a business I can do, to making sure our family has the proper type of life insurance, because there's a lot of life insurances, and there's really some types that are better than others. So making sure we get families educated in that. Mortgages, right? Can do mortgages as well. So dang near anything with money, I could do, pretty much.
Okay.
That's dope.
Okay, that's a bet. All right, so let's see. So it sounds like you kind of work with like getting like family started as far as the base level financial plans, is that what you kind of focus on? Is like far as setting up retirement, setting up your kids? You know what I'm saying? Is that your main focus, or if you get what I'm saying, what I'm trying to ask, like, yeah.
Yeah, 100%. So I got into it to make sure that all of us is taken care of. So I can help everybody if they have literally no clue what's going on with money, right? They're like, hey, I've heard of this stuff. I just don't know what to do with it. I can help them put something together. I also have clients that have real wealth as well that I help them manage and help them get into retirement. But my baseline thing, man, is to be able to have every single person I sit down with be able to actually retire. And when I say retire, meaning they don't have to work for money anymore, right? Because a lot of people, quote unquote, retire, but then they run out of money and they're working part time, right? Because they didn't set things up properly. So again, my goal is to make sure we're leaving our kids wealth if something does happen to us, making sure that our families are taken care of for generations. And it's something I ask people all the time is like, who was your great, 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 great grandfather? And most people are like, I have no clue because they didn't do anything big enough for you to know who they were, right? So are your
That's a
great,
bar.
great, great, great grandkids gonna know who you are because you're doing the things right now you need to do? So
That's
That's
dope,
a
man.
bit.
And I'm glad you said that, man, because that's something we, bro. This might have been the first episode we said this, bro. But I'm pretty sure we was talking like, when thinking of finances, right? When thinking of setting up your kids, it's almost selfish to not set goals for your kids' kids. You know what I mean? Because it's about, especially if you come from an area where, the subject of money is just super sensitive. You know what I mean? Like, it's you work hard, you get paid. 9 times out of 10, you live and check to check, but you put a little bit in the savings, and then you got some bread going to this retirement fund at your job, but you have no idea what any of it is. You just trusting and believing what the guy that came down and kind of explained the retirement plan at your job. You just trust and believing that guy is right in what he said. So we don't really know. And so in doing that, man, like what you're saying, man, it's important, man. I feel like if we set goals to, make sure our kids are good, you know what I mean? We'll overachieve for our own lives. You know what I mean? And our kids is right after us. So, all right. So let's get into this then, right? For the new investor, right? The person who age doesn't matter. But they see that, okay, I hear everybody talking about investing. I hear everybody talking about ways to make money in my sleep, to do all these things. Okay, but they have no financial knowledge, have no investing knowledge. What do you recommend that person do first? Is it something knowledge based, or would you just like how does it work?
yeah, that's a great question. I think a lot of times people feel like they have to be experts with certain things before they do anything. And I don't think that's wise necessarily, right? So what I tell people, the basis is you're going to learn over time, right? Like at any job, at anything that people do, they weren't the best when they first started, right? But they had to start to get great or start to get good, right? So when I teach people about investing, the basics, real simply, um, I think mutual funds are phenomenal for most people starting out. Just dang near everybody. Like there's a lot of people that can go through their whole life putting money in a mutual fund and retire. So how I explain this to people is if you had 2 elevators, one elevator had 1 cable, one elevator had 100 cables, which elevator would you get on, right? And everybody says 100 cables, right? And I said that's the difference between a mutual fund and an individual stock. Individual stock is one company. If that company doesn't do well, like Toys R Us or Enron or some of these other companies, and they had all their money there, that family's not going to be able to retire. But if they have their money spread out in a mutual fund between a bunch of different companies, one company does fail, they still have 99 other companies to kind of pick up the slack. So that's a great place long term for people to kind of put some money and start off. And then there's thousands and thousands that you can put somebody in, but that's generally what I do.
Okay.
All right. So what are the different types of investments, that you're familiar with? And which one do you believe is the safest for someone to start off with?
Man, there's literally thousands and thousands of investments people could do. I guess I could put stuff into a category, right? So kind of how I put stuff together for people or how I recommend people put things together is a basis of like 3 kind of buckets, right? Or 3 stools. I got all kinds of analogies. I'm sorry, y'all.
So we love them. Let's go.
So if you have a stool and it has 2 legs, are you going to be able to sit down on it?
Probably not.
Probably not, right? You got to have 3 stools or three legs, right?
3 legs,
Yeah, exactly.
So 3 legs for somebody's financial plan as far as saving money is going to be first leg. The least sexy thing is emergency fund. That's something we're not going to make a bunch of money on necessarily, but it prevents us from going into debt. It prevents us from increasing liabilities because if something happens, we could transfer money and take care of it, right? So the emergency fund is one of those big legs, right? The second thing is going to be like an intermediate fund slash, like that could be if somebody's planning for a big trip in 3 to 5 years, they're planning for a down payment of a house, something that they know is going to take them a little bit of time.
Mm-hmm.
That's not retirement. That's not an emergency. So it's good to have a pile of money for that. And then the long-term money, right? That's the third leg where if they have that money, they're putting away money for they're not even thinking about that every month, right? I teach people to pay yourself like you're a bill. One of the biggest mistakes that people make is they pay everybody but themselves first, right?
Mm-hmm.
So it's like we cannot. How do we build anything if we say, let me see what's left over, and then I will put that away. And guess what's left over? Nothing, because it wasn't a priority, right?
Yeah.
So make sure that they're putting away money automatically. Pay yourself like the bill. And long term, man, it's crazy how much money people have saved just getting in the habit of putting something away consistently every month.
Compound interest.
Absolutely.
Okay. So you said emergency fund, right? And you used a good analogy. And you used a good example because you explained, okay, an emergency fund is that what is an emergency fund, and what does it consist of? Is it? I mean, I know what it is, but what do you typically teach people as far as like the amount to put back? Is it 3 to 6 months? Bills 9 months.
And what's actually
what
an
is it?
emergency?
Yeah,
Right.
exactly.
Those are phenomenal questions because people are like, hey, I want these shoes that drop tomorrow. That's an emergency.
Exactly.
Nah, brother,
Yeah.
that's not an emergency, right?
Exactly.
So for me, what I try to do stuff in milestones. Since people hear 3 to 6 months worth of expenses, and that's overwhelming. So I try to work on milestones, right? I do a budget with people, right? So I'd encourage people to do a budget. If not, that's something we could do for sure, right? But you do a budget, you see what your bills look like. What you're making isn't what your bills look like. Does that make sense?
No,
So
definitely.
once you get in that situation, my first milestone, if somebody has $0 saved, is to get them to $1,000 as quickly as possible, right? I want them to get to $1,000 as quickly as possible because then they feel like they have something, and money attracts money. It's really hard to save $10,000 if you don't have $1,000 saved, right? As soon as somebody starts saving a little bit of money, they're like, man, this is easy. They like seeing their account grow. So then I'll try to get them to 2,500 is the next milestone, and then 5,000 is the next milestone for that emergency fund, right? Now, with that being said, in that process, we know what 3 to 6 months worth of their bills looks like, right? So $5,000 for a lot of people isn't going to be 3 months worth of bills. 5,000 for some people might be, but I try to get people to that number first, and then we'll visit that 3 to 6 months worth of expenses. But I try to get them 1,000, 2,500, 5,000 incrementally, and then we kind of charge towards that number.
Okay, that makes sense. Okay, so you go about by the amount itself and not what the overall bills are for each month. That makes sense. Like you said, milestone.
Yeah, man, because people work in milestones, man. If I say your bills for 3 months are $3,000, or for 1 month is 3,000, $9,000 is like, if they've never had that money saved, they're like, how can I do that?
Exactly.
Yeah. But if I can get them to $5,000 and I say, hey, our next milestone is 9,000, oh yeah, I'm halfway there. That's a totally different conversation.
Yeah.
Got you.
Okay. So, how much do you believe someone needs to fund their retirement?
Man, that answer is, it depends on the person, their kind of their lifestyle. But I'll just share this with you. About my age, I'm 32, right? So if somebody's about my age and they want to just retire on probably about $4,000 a month in today's dollars, with inflation, that's going to be close to $10,000 in the future, right? Like our parents and grandparents were paying for cars what we pay for, or paying for houses back in the day, we pay for cars now, right? So things are going to get more expensive. But for somebody to have a comfortable retirement, we're not talking lavish, they got to have about $1.5 million saved. Now that number sounds high, but it's not, and it doesn't take a lot of money to get there. It just takes time, just putting money away consistently. So it really does depend on the person, the kind of lifestyle they're having. But if they want to retire on about $4,000 a month, man, they got to have about that saved.
And what's the retirement age right now? Is it 65?
So it depends, is what I tell people, because there's the retirement age I shoot people for is 59 and a half. because that's when they can take out money from like 401ks, 403bs, Roth IRAs, etc. That's like the minimum age. They can take that stuff out without having taxes and penalties. So I try to get people to retire by that age. Normal retirement age is 65. But if we could retire sooner than that and enjoy life a little bit more, a little bit younger, then why not do that? You know?
Definitely.
And that was my next question, man. Like, you know, for the kids coming directly out of high school, right? And let's just say, right, this podcast is going to be the podcast that shift minds, right? It gets people thinking about investing early on in their lives. But what could a person do? And I know you said it depends on the lifestyle. But how would you set goals or manage, I guess, expectations for a person who comes out of high school working directly into the, you know, the work field, 18, 19 years old, but want to retire, you know, on an earlier end? Like, are there more aggressive ways that you can go about, I guess, teaching investing for that person, that younger person, so that they can retire a little bit earlier? 65 to a lot of people, it sounds pretty old, man.
Yeah, 65 to me sounds pretty old. As far as retire, like my goal right now is to have the option to retire in the next 5 years, right? Like, that's really what we're working towards. But I would say it's not as the investment options again. Like when I tell you guys, I don't want to nerd out on this podcast, but when I tell you all these investment options are plentiful, we have thousands and thousands of things I can put somebody in to help them hit a goal. But this is the more important thing. Money habits, right? If somebody's 18, 19 years old, it doesn't matter if they're 18, 19, if they're 50, 60, money habits is going to be the thing. You can't say you want to retire early and not put money away. You can't say, oh, I want to retire and got the newest cars, phones, shoes every single month, because what you're doing is you're spending money on something that has no value in the future, and that's less money you're putting away. I'm not saying people got to be like me, or one of my friends, her name, I call her Julius, you know, from Everybody Hates Chris. Doesn't spend money. She's bad. I'm not saying everybody got to be like that. You got to enjoy life. But they just, if as soon as somebody gets a first paycheck, I have a lot of clients right now. Their kid is 14 years old. They'll say, hey, you're sitting with Mike. So I help them put a budget together. Like, hey, they're 14 years old, learning how to budget their money. And they at 14 years old, they're maybe putting away 25, 30, 40% of their money at 14 years old. Now, guess what? By the time they're 18, it's a habit, right?
It's normal. Yeah.
So I would just say those things are the most important, because if you're living below your means, which a lot of people do not do, it allows you the excess to do some of these different things, to get into different kinds of investments. So I'd say the money habits is the main thing, man. Like really just understanding, just because I make $3,000 or $4,000 in a month doesn't mean I have to spend that much. Your goal should be to live on as least as possible and still have a quality life, so you can really have a phenomenal life later on with all the money you have saved.
See, that's where people, you know, that especially us in the Black community, man, that's where we kind of mess up at, man. We have a tendency to we make a lot of money, we can afford to spend a lot of money. Well, it's not the case, man. Like especially in setting up yourself for retirement. So yeah, I like that answer, man. Real quick, Dang, I'm gonna get into the next question, then you can hop on after this. You mentioned it a little bit earlier, briefly. You were speaking of IRAs and all that. But what is a Roth IRA?
Right. So there's two kinds. Roth is my preferred investment vehicle, because this money grows tax deferred, right? Meaning that somebody can put money away and not pay taxes on it while it's growing. And because it's a Roth, when they're 59 and a half, they can pull it out tax free. The IRS does not tax them. It's one of the only investments where the IRS doesn't have their hands in your money. And the reason they do that is because they're considering this money that you're investing after you pay taxes on your check already. So what they do is they say, okay, you already paid taxes. The IRS says, hey, we're not going to tax you again. I don't know how long they're going to be around. They've been around for a long time, but we just know as things progress, they want to get their hands on more money. But if you have a Roth IRA, you're grandfathered in, right? So I would just tell people, put money in that vehicle, because they can literally retire with $2, $3, $4 million at 59 and a half or whatever age they decide to retire, and they have that money tax free. They don't have to pay taxes on over time. So if somebody puts away $100,000 over 20 years, if it's average at 9-10%, they're gonna have over $1 million saved, right? And being able to put it in a vehicle where they're not paying taxes, they're not paying capital gains, income taxes, etc., is phenomenal. But it's specifically for retirement. And what the IRS does is they give people all these exceptions like, hey, if you have this happening, like a kid going to college, you can pull money out of your Roth IRA with no taxes or penalties. Why would they do that? So people have less money to get taxed on that retirement. What people
Mm-hmm.
don't realize is every $1,000 they pull out right now costs them about $17,000 in the future. So by them pulling out $10,000 from the house or $10,000 out of the retirement for their kids' college, that cost them $170,000 that they would have later on with compound interest.
Sheesh. Compound interest, man.
Okay.
That's something we need to discuss a little bit more. Hold on, real quick, because you answered part of the question. You said there's two types of IRAs.
Yeah,
one's the Roth. Okay, so what's the other IRA?
The other IRA is just called a traditional IRA or just an IRA, and that money grows tax deferred. And when somebody pulls the money out at 59.5, they're paying tax on what they pull out. The goal, the design of that is if somebody has all their retirement money later on and they're pulling money out, they should be paying less taxes later on because they're pulling out less money because they're not, they don't have all the kids in the house. They don't have as many bills, liabilities, and stuff later on. So that's the idea behind that. Generally, I only do that for people who are making too much income to contribute to a Roth because there are some income limits on some of that. Or if they have like retirement at their job, where if we move it from their work retirement to a Roth IRA, it's going to cause a taxable event. So I won't do that to cause them a tax issue. What I'll do is I'll move it from a work retirement program to a traditional IRA. There's no taxes that happen in that venture, and then later on they have that money to grow.
Okay, all right, makes sense. Makes sense.
All right. So, do you know? As I know, there's like a limit on how much you can contribute to the Roth IRA, but I don't know the exact number. Do you have the exact number?
I do have that exact number, right?
Okay.
So if you're under 50 years old, you could put away $6,000 a year, $500 a month, to be able to retire. If you're over 50 or over, they give you a extra $1,000 you can put away. So $7,000 is the number that they could put away for a Roth or a traditional. Something about the traditional I did forget is those contributions, somebody can write off a portion of the contributions. So it's that if they're putting away, $7,000 a year, they can write off a percentage of that on their taxes. But that's small amounts of people.
Okay. So is there a limit on the traditional IRA that you could put in like a monthly or yearly?
It's the same. It's the same for both.
Oh,
so
same numbers. Okay.
For traditional and a Roth, and it's the extra 1,000 if they're 50 or over.
Okay.
Okay.
All right.
All right. Well, go ahead.
Well, so the next question, what are 403Bs? Now, this you may have to explain pretty well because I haven't heard of this one. 403Bs.
Yeah. So a 403 is 403B rather is very specific. So that's generally for like teachers, public employees, etc. It's the equivalent of a 401k, but it's like a tax sheltered annuity, or essentially, so people are able to put some money away. So generally, those are for government officials or city employees or nonprofits as well. So that's what those are for. Most people haven't heard of them and won't hear of it because traditional jobs don't have the ability to have them, but they work almost the exact same way. They have almost the exact same rules as a 401k. There are some slight differences, but the main thing is it has to be an organization that's a nonprofit or like teachers, etc.
Okay, so I was up pretty late, doing research on this. So yeah, I was actually, the question before that was supposed to be about 401ks and the different types or the different funds. Could you explain that though? Because you kind of alluded to it a little bit, speaking on the 403Bs. But what is a 401k?
So 401k is just a work retirement program, a workplace retirement program, essentially, right? So the benefit of a 401k in my mind are two things, right? If your job matches you, meaning if you put 3% in, they put 3% in, it doesn't even matter what you're investing in necessarily because your money doubles every time you put money into it. Does that make sense? So I tell people if your job is matching you, contribute what they match you. First and foremost, right? Anything over the match, that's when people do their Roths, right? Once people are maxing out their Roth IRA, go back to the 401k because you have 18,500 you can contribute a year into that, right? The performance, there's some rules and stuff on 401ks where the investment options are severely limited. Jobs like having them because it's a tax write-off for the job to have. But here's the thing I need to explain to people: when you leave that job, take your money with you. Not saying to take it to your next job, not saying to pull the money out. Don't do those things. What you do is you roll it into a Roth or a traditional, depending on how it was set up at your job. Because what people don't realize is that's considered the asset of your employer until you move your money, right? So when all these companies go bankrupt, or if a company merges or gets bought out by another company, I've had people where they didn't listen and they left the money in their old 401k. That company got bought and they couldn't touch their money for 18 months while that whole thing was going on, right? So what I explain to people is this is a great program to have while you're at that job. But as soon as you have the clear when you leave that job, move it into your own individual retirement account, which the IRA is. And then that way you took your money, you took what portion the company gave you, and now that's your asset. Is not considered your asset until you move it from that employer.
Okay, so is the lifespan of a 401k, is it the same as the IRAs? Could you expect to pull from it without getting taxed, or getting taxed at a minimum amount at the age of about 59 and a half, 65, or like what's the life expectancy of that plan?
Yeah, 100% is 59 and a half. The same rules apply, but most jobs don't set up a Roth option. I don't really understand why they don't, but they don't, right? So most jobs are going to just have a normal 401k. They're not going to have a Roth 401k. So just think about this. If you have a Roth 401k or 401k, that's just a label on the account so the IRS knows how to tax it, right? So if you have the option for the Roth, you should always do a Roth, in my opinion, if you have that option. If you're making too much money, you do a traditional, but most places never do give their employees the Roth option. They just say, hey, here's a 401k. Now, again, I just want to emphasize this, right? But the 401k, a traditional IRA, those are tax deferred, meaning they don't pay taxes every year on the gains they have, right? But when you pull money out of those at 59 and a half or older, you do have to pay taxes. And another thing with those two programs is the government has something called RMDs, required minimum distributions. So when you get to a certain age, I believe right now they changed it to like 70 and a half or 71 and a half, you have to start pulling money out. Whether you need it or not, you have to start pulling money out. Why is that? Because they want their tax money. So a Roth IRA, you don't have to pull money out necessarily, right? You can leave that money there forever because you already pay taxes on it. The traditional money or a 401k, they're going to make you pull the money out eventually because they say, hey, you got this big pile of money. We need our taxes. So they make you start pulling money out eventually.
Okay. So while we're speaking on taxes, this is one I'm going to throw in. I think I can't remember what episode, Tyler, but I know I went into where like one of the two or three biggest things to beat while you're trying to grow your money is to stay out of debt and taxes. So do you have any quick tips on, well, it probably can't be too quick because I know taxes can kind of be kind of funny, but do you have any tips on how we can kind of mitigate our taxes? Which I know, I guess the Roth IRA would be one vehicle, but do you have any other, options for us?
100%. I'm so grateful you asked that question. And this is something I say all the time to people. Tax evasion is illegal, right? But tax avoidance is not. So we got to get the knowledge to start avoiding paying taxes like a bunch of businesses do. So a few things that help people out is being self-employed or having a business is a humongous tax write-off, right? And again, I'm not a tax preparer. I've just been in business for a long time. We have a partner that is a tax preparer, or CPAs and stuff that really get on the game. But and I'll definitely get y'all their information. But I know enough to let you guys know this. Tax avoidance is what I specialize in because there's a bunch of different ways you can put people in stuff. So if people have that intermediate money I was talking about before, there's a bunch of like bonds or municipal funds, stuff like that we can put people in. With the government, you're pretty much loaning the government money that they're required to pay back. So one of the trade-offs for that is you loan them money, they pay you back, and you don't pay interest on the money they pay you back and the money you make, right? So that's a good way to leverage debt, right? A lot of times people are used to being in debt, and sometimes it's good to have somebody owe you money, right? And that's tax deferred. So and then let me actually go back a second too. There's something you said you got to limit. You're 100% right. Inflation is one thing we know we're going to be up against, right?
Yeah.
Taxation's another thing, right? So those are two things we know we got to. Those are two things. If we don't know nothing else, we know those two are going to come, right? And then just making sure that people have that dollar amount saved. So a Roth IRA is a good way. And then leveraging. So once people are in the position, leveraging money towards different real estate ventures, different things like that, right? Become a business owner of some sort. Like I know business ownership ain't for everybody, but if you're somebody who's tutoring kids and you're doing that volunteering for free, that's phenomenal. But guess what? You can write off some of that mileage, right? Does that make sense? Have it if
Mm-hmm.
you're a business owner and you have some equipment or these different things that people do. There's a lot of write-offs. Our system is designed to really alleviate that, and that's why people will say like, "Oh, Jeff Bezos or all these other people, they're mad if they're not paying taxes." You should be mad. You should say, "What are they doing that I could do, so I could
Exactly.
pay less taxes?" Right?
Mm-hmm.
Exactly.
But there's a bunch of ways, man. Like I have a home office here. I have an office. We can write off a percentage of our home office square footage on our taxes during the year. Does that make sense? I can write off a
That's dope.
percentage of my cell phone bill because every client has my cell phone number. So I do a lot of business on my cell phone, right? So I'm saying all that stuff to say there's a bunch of different tips and techniques that we can use. As far as investment accounts go, it's just a label that's on the account. So retirement accounts, generally speaking, are going to be tax deferred for the most. Individual stock cannot be considered a retirement account that has those tax advantages, though, for the most part, right? Um, there are a few exceptions on that, but if you're venturing into some of that, I would just say just know whatever you put in, that's not going to be tax qualified, and just know the government's going to try to get their money. So if you make some
Yeah.
big money, they're going to be happy for you, and they're going to say, "Hey, brother, I'm gonna need about 20-30% of that." Is normally how that works out.
I'm
Yeah.
telling you, they're gonna get there.
Yeah.
All right, so you you mentioned ways to avoid, but would you, besides a tax preparer or a CPA or all that, do you know of any like specific resources that someone can go to and just kind of read up on to uh avoid being taxed at what I'm saying, at a certain rate?
Right.
Um yeah,
What
go
I
ahead.
would say, we have a book that our company, our partner with, wrote a long time ago called How Money Works.
Mhm.
People could just Google that. It's like 40 pages. I actually sent it to both of you guys. It goes through some money basics and stuff, but there's a
Yeah.
whole section on taxes and some ways to avoid stuff in there. Um, I would also encourage people like to read and listen to audios, man. Like there's so much. Like obviously the audience that you guys here listening to this, they're doing this on purpose, intentionally to get better at life, health, and wealth, right? That
Mm-hmm.
they're listed in to get better at those three things, right? So I'm just saying on some of this other stuff, put in some more time. If you don't want to sit, in, I love that sweater. I can't wait till it drops so I can get one.
Hey, yes,
It's
sir.
coming.
Yes, sir.
It's coming.
I might have to get a pre-order or something, brother, because it's getting cold
That's a
over here
bet.
now. So,
Hey,
Yeah.
we'll talk off camera.
yeah, for sure. But I would just say do some more research on some of this stuff, because again, I looked at these questions y'all sent, and I told y'all before we got on camera, like, man, this is a lot of these topics, and taxes is one where there's so much information. It's very hard to get people to those to get people like these basic nuggets. But I would say like putting away money in a retirement program. If you're putting money away for your kids, there's a bunch of tax shelter things you could put money away for kids in as well,
Mm-hmm.
whether that's education, etc. For your retirement for you and your spouse. There's a bunch of different ways. And if you're self-employed and you're making really good income, there's another kind of retirement program called a SEP and a Simple. So those two have different income limits and contribution limits than a Roth IRA, traditional IRA, 401k. But the business gets to write off their contributions, and they also get to save more money than they could save in like a Roth or a traditional or 401k. So when people get the money together to do those things, because I mean, somebody literally could put away $58,000 a year in a Simple, I believe.
Mhm.
$58,000 a year, or 25% of their income, whichever is less, and that's a write off for their business. They're
And you
paying
know
less
what?
taxes.
It's
And
gone.
see,
Yeah.
it's that's dope. And it's okay that you feel like it's a lot of information and you're not able to give everything
We
that you want
probably
to
gonna
give.
have you
Because
back on. Yeah,
no,
we're gonna have you
and,
back on.
and I was just about to say this is a
Yeah.
surface level information. You know what I'm saying?
Yeah.
Episode, we just want to kind of get people thinking about it. So
Yeah.
when we dive into it further later on, they'll at least have like, you know what I mean, a starting point.
Baseline.
You know what I
Yeah.
mean? A baseline,
Right.
exactly.
Mhm.
To what we're talking about, man. So okay, all right, cool. So all right, let's get into, you kind of talked about it a little bit earlier, but like let's get into teaching our kids about money, right? Like, what are some of the techniques you may use to just teach your kids the basics of money and how to manage it?
Yeah, so kids are brilliant, whether people realize it or not. Like kids that grow up broke, I don't know about y'all, but I grew up poor. We didn't grow up with
Me
a lot
too.
of money, right?
Well, I wouldn't say poor, but we were
Hey,
what
brother,
less
we grew
fortunate.
up. we grew. Yeah, you're right. We grew up in a situation. I'm like the youngest of 6. There was 8 of us in the house, and we didn't have Nikes. We had Fikes. You know, we had you know, it was rough. But you know, learning that conversation, something I'm going to give my parents a bunch of credit for is they didn't know what to do with money necessarily, but they knew what not to do. Right? They knew what not to do. So what they told us is they didn't say we don't talk about money. They talked about it. They told us a bunch of stuff. They showed us how to, you know, balance a checkbook. That's like an ancient thing now. They showed us this is how you balance a checkbook, do all this stuff. So we were learning this as kids. And I was like, this balancing, some ain't balanced over here in this checkbook, according to my calculations. But I think just having conversations with the kids, not having the we don't talk about money conversation, because if you don't talk about it, you can't expect them to get good at it, right?
Exactly.
So right now, my oldest is 9. She has a good amount of money saved. I'm not going to put her business out there, but my goal is to have all my kids at 18 have $50,000 saved when they're 18 years old, right? And the reason that is, and on the way to that, we're educating her. My daughter right now, 9 years old, has her business. What I talk to her about is, you know, this is she knows how to do a profit and loss statement, right? Because I show her, I say that because she has, Dad, I need this, I need this, I need this. Baby, this, and this costs money, right? So I'm investing in your business, right? But this is how much I had to spend. So I spent that so you can get your business started. You have to continue to spend that to keep your business running, right? So she understood this is what my expenses are. This is how much I'm making, right, to cover these expenses. Then I said, so how much do we have to price each one of your chocolate covered Oreos at to cover all these expenses? So she figured it out.
How old is she again?
She's 9, and she's been doing this for about a year now. So again, I think just put it on an elementary level. Have conversations with your kids about the basics of budgeting, right? What are some good ways to make money? This is what I talk to kids about. I go into schools and teach this, right? What are some good ways to make money before you have a job? And kids will say, raking leaves, shoveling snow, you know, selling ice cream. Like this new generation of kids, they really got the entrepreneurial hustler gene in them, right? So I would talk to your kids about ways to make money that doesn't include you giving them money. Talk to them about a plan for that money, which is what a budget is, and show them immediately, hey, you don't have expenses. Start putting away some of this money, whether that's 10, 20, whatever, 30%, whatever that number is. Something my mom did for me, she didn't put it in a great place. She just put it in the bank. But when I was working, she took 40% of my check. So 40% of my check she took, 10% went to tithes, 50% I got to spend. I was so mad. I was like, man, I'm doing all this work and I want to get to spend 50% of this money. I didn't have no bills though, right? So, but when I turned 18, when I was going to college, that 40% she put away from 14 till I graduated, I had so much money saved, I wouldn't have bought a car cash. You see what I'm saying? When I was 18 years old, because my mom put away the 40%. So I'm just saying, man, like that built a habit in me. Like, shoot, maybe this whole saving money thing isn't a bad idea. I wish she would have let me see what it looked like. I just knew she was taking the money. I didn't know what she was doing with it, but I just take it a step further and show my kids, like, this is what your money's doing. This is what my emergency fund looks like. This is what our business accounts look like. I let them see all that. My daughter said, oh, you guys are wealthy. I said, no, we're not yet, right? That's a cool number, but we're not there yet. I want this to have a lot more zeros in it. But I think just involving your kids in some of that stuff, budgeting, paying some of the bills, letting them see that process and just communicating with them, they're going to pick up and retain way more of it than you realize.
Definitely. And I know Daryl, man, he actually gave me a good tool a while back and he probably forgot, but there's actually an app. And I still use it. I don't know if you still use it, Daryl, but I still use it to this day. It's called Greenlight. Yeah.
Oh,
Greenlight.
Yeah. I was just gonna mention it. Yeah. It's dope.
Okay. Yeah. So he put me on that, man. And Greenlight, it's a dope tool where, you know, you can so basically you have a parent wallet, used for, like, you know, where you can disperse the money to your kids if you have multiple kids or just one, whatever it is. And I have 3. So but 2 of my daughters are on it. My son is on something else that I have for him. But anyway, and the parent can actually set up. So okay, I'm gonna just use the exact numbers I do for my kids, right? So I give them about $30 a week for allowance. I have it set up where 33% goes to saving, 33% goes to an investing account, and then the rest that's left over, they have to put a certain amount. They have to give back a certain amount, 10%, and then the 20%, 20-something%, they can spend, right? And they always get mad, like, we only got, so many dollars to spend. Well, I tell them,
you got to buy.
Exactly. You ain't gonna buy nothing but a doll or something like that,
Yeah.
So I tell them, I was like, listen, you'll have more if you sit on it, let it kind of, stack up. And then
Mhm.
even then, only spend a portion of it so you can, you know what I mean? You'll have some in reserves. And I know you have a savings account and all that stuff, but that's different from what you have available, cash on hand. So that's a tool for people who are looking to do something like that. Greenlight, it's an app, should be on both app store, whether you have Android or, of course, the greatest, Apple. He's an Android guy. So
Android, oh man,
big Android guy, man.
Oh man,
I
just
told
lost
him,
a couple cool points right there, my guy.
I told him that I used to be heavy on Android, like back in, I don't even remember. It's been so long, probably 2015, something like that, 2014, whenever I converted. But yeah, so yeah, that's a tool, man, that y'all can use, man. So definitely.
And another quick note on that: if your child has a smartphone, they can actually log into the app on the child side as well, and they can see where the money's going, and they can see like the investment account growing as well. So it's a dope way to get them, acclimated into it early. You get what I'm saying? So once they're on their own, man, it's automatic. You get what I'm saying? So that's what I like about it, man. Yeah, it's just real cool.
I think that's smart, and I think it just goes into that conversation of showing a kid, like, you make this much money, you're putting this money away, you're investing this much money, you have this much to spend. That's really doing a good job of automatically teaching the kid to budget. And really, my big thing is like having people avoid debt, right? So if you start that when they're young, obviously you do need some certain things to build credit. We won't get into that discussion today. That could be a whole episode on its own.
Oh yeah.
There's certain things you need to do to build credit. I understand that, right? It's a game. But with that being said, a lot of people over leverage themselves with debt that they're not doing anything with, but making a payment to a company. They're not making any money on it. They're not leveraging that debt.
It's not smart debt. Yeah.
Exactly. So teaching a kid that early on, like my daughter, when I was explaining to her, she was like, so if somebody doesn't have it, then why don't they just save up the money to get it? And I said, that's a great question, right? So do that, right? So like, and I would tell you guys, I would encourage all your listeners to do this. Go to your kids right now and say, hey, so would you rather have $1 right now? I'll give you $1 now. Or would you rather have $3 tomorrow? You're going to be surprised how many of these kids say, I want $1 now. But then you'll have some of these wise kids that say, I could wait one day and have $3 tomorrow. And then tomorrow comes, they're going to say, hey, where's my $3? You give them $3, right? What you just told them is the power of waiting to do something certain times is going to cost, is going to reward them more, right?
Compound interest.
Compound interest, right? So I teach them, like, I try to do these small little things like that. So when I'm having these conversations as they're older, they're already getting the concept.
You know what I do with my daughter, man? Like I pay them, obviously I give them allowance and stuff like that, but I actually pay them double to learn something, right? So I encourage, because I always tell them, and they hear it every day, they get sick of it. Because I'll even ask them to repeat. I'm big on having them repeat things I tell them, so I know that they're really hearing what I'm saying. But I actually pay them more, twice as much as I pay them to clean their room or whatever, to read a book, right? So it encourages them to learn, because learning will always pay you more than any physical activity you can do to make money. So that's something, that's a little nugget I use, man, and that's something else y'all can throw in y'all little parent bag or whatever. But yeah, encourage learning and reward it, because it's big. It affects the way they grow up. All right. Okay. Next question. Oh, go ahead, man. Get into it, man, because I'm thinking about something else right now, man.
So I know, and this is something that I'll be transparent, man. I don't have a life insurance policy of my own, but I know that's something that you need to have, like, and it's more so for your family that you're leaving behind. I don't want to leave this earth anytime soon, but just in case I did, they'll be okay financially. So can you get into that? Like, what are like the best life insurance policies for us to?
100%. And
what are different types as well?
And different types,
yeah. I'll keep that a real surface level because those get complicated. But I'll just kind of tell you guys my personal opinion, my personal experience, and this is something I'm very passionate about for several reasons, right? The first reason is Black people were not allowed to have life insurance at all until like the early 1800s. Life insurance has been around since the 1700s. We weren't allowed to have life insurance till like the mid 1800s, and we weren't allowed to have certain types of life insurance till even later on, right? So what would that tell you? Before I tell you the types, if we weren't allowed to have certain types, would those types probably be better than the types we were allowed to have? Would you guys agree with that?
Definitely.
Right. So I say that to say the kind that's most common in our community, and this is one of the biggest reasons we have a tenth the wealth of our white counterparts, is like different forms of whole life insurance, right? The cash value kind of policies are typically the worst. That's what we were allowed to have first, and there's a reason, right?
You said whole life?
Cash value, whole life type policies. So there's like index universal, variable universal, whole life. I mean, there's literally thousands. They change every time people figure out what they do, they change the name. Those policies do way more for the company than they do for the person, and they cost way more money. They cost 5 to 7 times more monthly than the counterparts for the same amount of coverage, right? So those kind of policies, what happens is, I don't know if you guys have seen like those Gerber grow up plans and some of that stuff. Those are forms of cash value. So they say, hey, you put this money away, your kids will be able to pay for college. That's not true. Because the amount of money people are putting away, they may have like $1,000 or $2,000 in there, but this is what they don't tell you. When you pull that money out of any kind of cash value policy, and if somebody doesn't believe me, I'll leave my information at the end and I could show them, and I could physically show you. I could show you better than I could tell you. I could call your company with you and I could verify all the stuff I'm saying, right? This that kind of life insurance, right? If they take that $2,000 out, they have to pay that back at 8% interest to the company, right? 6 to 8% interest. So they have this cash that they're putting away, and they have to pay the company to take their own money out. If you went to a bank and you were putting money away, and they said, "Okay, Daryl, actually, the worst part is the first 3 years they're putting away money, they have zero cash. So you go to the bank, you've been putting money away every month, and you say, hey, I need to pull out $200. And they said, oh, sorry, you've only been putting money away for a year. You have no money. Would you continue to bank there?
No.
Probably not, right?
I'll be ready to fight with my money.
Exactly, right?
Yeah.
And then what they do is, so you say, you know what? I'm going to not fight them. I'm going to just keep putting money away because my grandma told me this is a good policy, right? So you keep putting money away. Year 3 comes, you have some money. You go to them and you say, hey, can I pull $300 out? And they say, absolutely, Mr. Brown, you can pull some money out, but you actually have to pay that money back to us at 8% interest. So not only do they have no money the first 3 to 5 years, when they do have money, they have to pay that company back 6 to 8% interest. And then the worst part is when somebody passes away, if they have that cash value there, they also has a policy face amount. So they could have like a $50,000 of life insurance or whatever, hypothetically, and they have $8,000 in that account. When that person passes away, their family either gets the 50 or the 8. They don't get both, right? So they're paying for 2 things and only get one. Where I'm from, we call that a ripoff, right?
Definitely.
You know what I'm saying? So that kind of life insurance was readily available for us, right? And they'll do different things with it and say, hey, you get to borrow your own money. You get to do like really, they sell people on this stuff that if they really slow down and think about, why would I want to borrow my own money, right? Now, in my personal opinion, again, this isn't me being biased. This is just looking at numbers. The only time it makes sense to have a policy like that is when somebody's above the estate tax, which is like 11.61 million or something like that. Because the amount of money they're paying for the life insurance is going to be less than the taxes their family would have to pay on their estate, right? So if somebody's in that situation, that might be a good option for them because they're paying money to take care of the taxes for their family, right? Other than that, we got to shift away from life insurance being just to bury people, et cetera, because that's not what it's for. Life insurance is designed to be income replacement, meaning I make a certain amount of money every month. My wife makes a certain amount of money every month. If one of us were to pass away and our bills are realistically right now, something happened, either one of us, the other person could take care of all the bills. But if we were in a situation like most families, half the income stops, your bills don't get cut in half. Does that make sense? They don't say, Mr. Williams, I heard your wife passed away. We're going to give you a 50% break on all your bills. That doesn't happen. What you see happen is their income cuts in half 50%. They don't have enough money to bury somebody, or maybe they just buried them and that's all the money they have. So there's another program called term life insurance where you're really renting wealth with that kind of insurance. Does that make sense? Until you accumulate wealth, you're renting wealth. It costs 5 to 7 times less a month to have term insurance for the same amount of coverage, generally speaking, right? And it's straight insurance, meaning if somebody could spend $25, $30 a month and have $150, $200, $300,000 of life insurance coverage on there, whereas they'd have to spend $100 to $150 to have the same amount of coverage on the whole life policy.
Okay, with the term though, right? And I don't know if you're about to explain this, but I want to just make sure we cover it real quick. Is that does that policy cover you in like increments, right, of your life, or is it like how does it work? Is it like, okay, this term lasts 10 years, and this policy is gonna cover you for that term up until age whatever you are, whatever age you'll be 10 years from now, or like how does it work? Explain it a little bit further.
Yeah. So that's the not quote unquote that term policies will have is there's generally anywhere from a 5-year term, which is useless, to like a 35-year term. So there is a wide range that people could do. Now, the company that I partner with, we actually can do some things a little bit differently with term life insurance. Like we're the only company that can do it because we created our own life insurance. But somebody could have, a 20, 10, 20, 30-year term, right? And then 30 years from now, if we need the same amount of life insurance we need right now, if we need more, then that means we have not accumulated assets. Does that make sense? So if I haven't accumulated assets, then I would need more life insurance. If I haven't helped one of my clients accumulate assets over 30 years, I'm terrible at my job. I know I'm really good at what I do. So what we do is we put a plan together from to pay down their debt or pay it off, right? Including the house. Put a plan in place for them to have tax-free income coming in through, whatever vehicles we use for that person, right? And then if their kids are grown, so think about this: if their kids are grown out the house, all their debts paid off, and they had $300,000 life insurance, but they have $1 million saved, do they really need the $300,000 if they have no debt, essentially no bills, and $1 million saved? No, is the answer. They have the option at that point to need the life insurance. Most of us, we got to get to that point though. And I have a bunch of clients right now that have enough money saved in places where it's tax-free that they're okay. So again, revisiting what you were saying, they do last anywhere from 5 to 35 years. And it just depends on what the person needs. Most people can get a 20 to 30-year term very affordably. It gets them way more coverage. And unfortunately, or fortunately, I don't know how you look at it, I've paid out 10 death claims to families, right? I brought 10 families checks. They didn't have to go do GoFundMe because they funded themselves. It didn't cost a lot of money every month. The biggest check I brought to a family is about $450,000, right? That changes a family's life. They don't have to worry about how am I going to pay bills? I have to go back to work. How are my kids going to do X, Y, and Z? Because they have the money there, right? Yeah. And we just paid out a check a couple months ago for $150,000 as a family. So I'm saying all that to say, like, have that in place because none of us know our time or day, right? None of us know how long we're going to live, but it just makes sense for us to prepare and to prepare our kids. And it doesn't have to cost a bunch of money. Life insurance should not cost that much money. It costs less on most cases than your auto insurance and your house insurance and your cell phone insurance does. So.
Okay, and this, I got you, Nate, real quick. I got this. This is on life insurance again. All right, so I feel like a lot of people have this question, but people are kind of timid to ask it. But with life insurance policies, right, whether it's term or whole life or whatever kind of policy it is, are there stipulations on the type of death, or is it no matter how you die, it's paid off?
That's a phenomenal question. So there's a couple types of policies where they do have these exclusions. I don't do those, right? So there's one. So I'm glad you asked that because it kind of leads into another type. So there's something called AD&D, which if most people look on their pay stubs, they'll see a couple dollars coming out for AD&D. It's accidental death and dismemberment. Those policies. I don't know if y'all fellas seen Final Destination, but you got to die from something like that. Like you're walking across the street and a plane hits you. That's the only way those ones pay out. So those ones literally have exclusions that say if you die from any sickness, infirmity, illness of the physical or mental, they don't pay out. That's how 90% of people pass away, right? So those are worth less than the paper they're written on. There's also these policies where if people have really bad health issues and the only coverage they can get is the kind that they incrementally pay. So the first 6 months that they die, they get like $2,000 back or something like that. And then the next 6 months, they get an increased tier. And then after 2 years, the full amount pays out. Those policies shouldn't be commonplace, but if somebody has health issues where they can't get other coverage, that is better than having nothing. Does that make sense? Gotcha. And then the last type is like group coverage. So this is what I hear people say all the time. So these are two things I'm gonna touch on, and I'm gonna hurt some people's feelings, I'm sure. One of them is group coverage. So this is your job. So there's insurance at your job, life insurance at somebody's job, a percentage of that, if their job is paying any portion of it, any insurance somebody has at work, when they pass away, their family is taxed on a percentage of it. Normal life insurance outside of work is tax-free. So if I die, my wife's going to get a big check that's tax-free. She has to pay 0 taxes on. If I have that coverage at work, she would get taxed on those proceeds, right? And then another thing I tell people is we know jobs don't want to pay us a bunch of money. Would you guys agree with that?
Of course.
Mm-hmm.
While we're alive. So what are the odds a job is going to pay your family a bunch of money when you die? Even less.
Exactly.
So think about that, right? Like, don't rely on a job for your coverage, because a job can fire you. You could get sick. There's all these things that can happen, and that coverage goes away. Now, the last thing I hear all the time, and I flame people when they tell this to me. I'm a pretty cool person, and I'm professional. But this one, when somebody tells you, "Well, my mama got a life insurance policy on me," you're grown, bruh. You know what I'm saying? You know, my mom used to have my social security cards too, but guess what? I got them now. You know what I'm saying? Right? So there's like, you can't be grown and say, "Yo, my mom got a policy on me." That's great. What's up with your kids though, and your spouse, or your other half, right?
Exactly.
Is your mom going to be able to bury you and fund them the rest of their lives? The answer is probably no, right? So be a grown up, put your big boy, big girl pants up, and say, "Yo, I've made this family. I'm responsible for taking care of my family." And again, it doesn't cost much money to do it properly. If you sit down with somebody that's a professional and really is looking at the benefit your family the most, it doesn't cost much money. I'm telling people it's literally less than their cell phone bill a month for life insurance. It doesn't cost much money, you know?
That's crazy.
Yeah. So I felt a little hit on that, but that's why I said I gotta get some. But it's just a fact of, and me just being transparent again, it's like, man, I just don't see where I can budget it right now, but I can make something move to, because that's important, man, because that's just leaving something for my children, man. So I'm probably gonna get with you on that, but that's something I definitely got to get done ASAP. But I just want
I don't want you to feel like I said, because I wasn't taking a shot at you. I was taking
a
shot at,
I mean,
no,
that's just smart. That's just smart.
Hey, we do that to each other all the time.
Yeah,
so he
you good. Yeah, I ain't mad at all, man. But I just want to backtrack for a second to kind of get some clarity on the term policy for myself and maybe the audience as well. But so with term, okay, you're buying it for a set amount of years, and basically how I'm understanding is like you say, you're borrowing someone else's wealth in case something were to happen and you do pass, But okay, so once the term is complete and you say hopefully we're in a position where we don't need life insurance anymore, but the money that we put into the policy, do we get that back at the end of the policy?
The answer is no, and the reason that is just like auto, right? So if we don't get in an auto accident, our insurance is like, "Hey, you haven't gotten an auto. Here's all that money back." That's part of the business, right? It's essentially you're taking you're playing Russian roulette with a company, essentially, right? Like hopefully a reputable company. They're saying, based on your health, we don't think anything's gonna happen to you, and you say, "I agree," but if you're wrong. So, like, realistically, somebody, if they're paying $1,000 a year, $83 a month, they're paying $10,000 over 10 years, right? The amount of money that they're paying for that could leave their family $400,000 or $500,000. So if I know I could pay $10,000, and if I pass away, my family's getting $400,000, I won that. Would you agree?
Yeah.
Now, if I'm alive, I'm not going to be mad and say, "Oh darn, I should have died so my family gets this money." in that time, I tell people, like, we got to be putting away money. That's what we budgeted, right? In that time that we have that insurance, we're paying off debt, so we're limiting liabilities, and we're investing. Every single one of my life insurance clients has an emergency fund, and not all of them have retirement quite yet, because that's something some of them have to work their way up to, but they have life insurance and emergency fund. And then we work our way to retirement long-term money. So again, at the end of that, they don't need to have insurance. But something we do that a lot of companies don't do, is once somebody's covered with us, no matter what happens to them medically after they have that policy, if their term runs out, they're able to get up to that same amount of coverage without a medical test. Most companies, if you have a health issue after you get covered and something health-wise popped up, they say, "Oh, sorry, brother, you can't get coverage anymore." We're different, right? We take it at the health they were at when they first applied, or their health now if their health is better. So once somebody's approved with us, we can guarantee them coverage till age 95, and the average life expectancy is 78. So does that make sense? So a lot of times we're able to get people in situations where, again, we get them good coverage, and they should need less in the future than they need right now. Because when my kids are grown, right, like, they're growing out the house, they're always welcome to come back. They're also welcome to do that. But I'm leaving them money when they're 18 for them to really start building some wealth right away, right? So if they don't do the proper things with that, they can't say, "Hey, Dad, I need 50,000 more. Sorry, I love my babies, and I'm
Yeah.
lying because they'll probably get it. They'll probably get it from us anyway. But my whole thing is like, we're prepping them to be resourceful with their money. So if we're prepping our kids to do that, we got to take the initiative ourselves and be like, hey, over the time I have this life insurance, I'm going to make sure I get myself in a bulletproof financial position. So when this term comes up, I either need significantly less or I don't need it at all. And again, do investing. It's called buy term and invest the difference is a big concept. You can look that up. That's how we teach families to do it, and they have way more wealth. And there's a reason Black folks were not allowed to do term insurance. We could not do term insurance till like the late 1800s, early 1900s, because they did not want us to die and leave a bunch of wealth to our families, right? Like they didn't want that happening. So they said, you guys can only have whole life insurance. And people still do that now. I'm like, if they didn't want you to have it, there's a reason, right?
Yeah,
so do what they didn't want you to do so your family can be in a better position now.
All right, so so in that situation, is there a case, right, financially, right, in someone's life where, as far as from your professional point of view, that you would see it as okay for them not to have a policy? You know what I mean? Is there a certain position financially that a person can be in for it to be okay for them not to have a policy?
100%. And that's my whole goal, to get everybody in that position. But that position would be, if you pass away, you're leaving your family enough to take care of the liabilities that are left behind, right? Pay for college or whatever, if that's the goal, leave some money to your kids to bury you, and to not miss your income because you left them enough money. Most people aren't in that situation yet, right? So I just feel like, again, we want people to be there. I'm telling you, I've told people, I've sat down with some higher net worth clients that were like, hey, I want to get life insurance. And I sat down and analyzed everything. We made some investment moves. And I looked at it and I'm like, yo, like, we can do life insurance for you, right? And I'm very transparent, Tyler. You met me. I think you can understand in the time we met. Like, I'm a very honest person. But I said, hey, your goal is to do X, Y, and Z, and you have $2 million saved right now, and you're only 40. So this actually happened. You don't have kids yet. By the time you have kids and all sort of stuff, and your kids are grown, this $2 million could be like 10, right? So in that situation, because they lived really below their means, you really don't need life insurance, because right now you only have a mortgage payment and you don't have any kids. You don't have none of that. They didn't need life insurance. They had a lot of assets and low liabilities. So that's really when people get in that situation where they don't need it, is when they have a lot of assets, low liabilities that their assets can take care of it and keep going and keep growing. But until people are in that position, rent the wealth. That's what it's for. Like, rent it until you have it.
And what were some of those assets?
They had cash for one. They had two paid off rental properties that could generate that monthly income for their family minus, and then she had money aside to maintain the properties, etc. She was retired from the military, so she had the military pension as well that she had coming in every month that she could live on to pay all her bills. And then she was still working, and she makes 6 figures at her job. So it's like, she was in a position when she was in the military. And in the city I'm in, there's 5 military bases. So we sit down with a lot of people that can do this if they're thinking correctly. But she really was an officer living way below her means, right? She had some of her like E4s, E5s that had nicer cars than she had. And I'm not saying people got to be that frugal, but at least she was so freaked out about not being able to retire, like she wanted to retire, that she literally lived on a third of what she made a month and put the rest of it away.
And it's extremely doable, especially when you're an officer. But it's crazy because these are some of the individuals that come into the military, regardless of branch, who have the degrees and all that stuff. But a lot of times, man, most of them, even though they make all this money, at least from from the military perspective, they are some of the worst. Handlers up. You know what I mean? Like they'll get paid a lot, but like you said, they'll have a lot outgoing as well. So it's good to know that somebody's actually doing the right thing. Living below their means and then investing the right way. Quick question, and I try not to make anything about race, but just for the show, was that person African American or no?
No, it was an Asian lady.
And see, and that's the thing, man. We trying to make this, we're trying to normalize this in our community. You know what I mean? And it's sad to say, but I kind of knew it wasn't.
But here, let me tell you something, dude. Give you some encouragement, right?
Okay, let's go.
My biggest client until I got her as a client is a black couple. They've never made over $80,000 a year. They got a paid off property here that they rent out. They got a paid off property down south somewhere. I'm not going to say where they're at because if I said that, people listen to Springs, they probably know what I'm talking about. They got a paid off property down there. They got a pension from their job. They got a bunch of money saved with me, and they had a pension from the military. They're financially independent. If their military check and the check from their old job pays all their bills and some, but they still have the rental income and they still got a pile of money saved. Does that make sense? So they never made over $80,000 a year combined, and they got in that situation. It doesn't take much to get there. It just depends on what we do with the money while we're alive. Because I've sat down with people making really good money, and they had $300,000 of debt outside their house. So they were just blowing it, right? So I mean, just I'm telling people, just develop the money habits now, because you're not going to become wealthy and have good money habits. So develop those good money habits now, so when you attract wealth, you have good money habits.
Yeah, that's dope, man.
So, okay, so you work with people to get them financially into a position where they won't need, hopefully, won't need life insurance. Can you hear me?
Mm-hmm.
Okay. But I know once you get, I don't know the set number, but I know once you get to a point, like you're more susceptible to the government coming for your money once you get to that tier. You know what I'm saying? And just say if you were to pass and to leave that to your family, isn't there like a tax that the government will take from that money if you don't have it like allocated properly to like an estate or other vehicles? A trust,
100%. So, well, I'm glad we circled back around to this. So, I think people should do what they need to do at the time they need to do it. When I'm saying that to say, everybody needs to at least have a will, right? Doesn't matter your net worth, have a will, because that's going to tell what happens with your kids, the money that you do leave behind if you don't have a bunch of wealth, where it goes, where your assets go. Because I'm sure all of us have been to a funeral, and then after the funeral, people are like, well, I want this watch, I want this clock, I want this. And it's just like, it just makes the whole thing even worse than it had to be because somebody didn't leave instructions. So I tell people in the beginning, at least have a will. Once they get to about 100,000 in net worth or something like that, which doesn't take long, and even having a life insurance policy that's over $100,000, guess what? When you pass away, your net worth would be over $100,000. At that point, it might be a good idea to have a trust, because that's telling exactly where the money's supposed to go. It actually helps execute where the money's supposed to go and what's done with the money. So that's a big thing. The thing you're talking about is estate tax, but that's 11.65 million that people have to have before that happens. So don't do stuff that people that have an estate that are paying estate taxes are doing right now. Build your estate first. Minus having a trust set up. Having a trust set up, I think, is wise if you have multiple kids. And you're leaving out besides some money, just because you can really dictate exactly what happens with the money more so than a will. Plus, you can pass probate court and some of that other stuff when somebody passes away doing that, because you have a whole plan in place. So I think that is something people should do. At minimum, they should have a will. Once
then
they get
a trust.
Then a trust.
Then once you get past 11.6 million,
11.65 as of now, that number can change.
Okay, and that's when you should set up an estate. Have your estate.
Well, the trust can set up the estate stuff, but they would have to update it, what they want to happen through that process as their assets grow. But again, I think it's like, so I'm from Colorado. I'm a Broncos fan, right? I'm just going to give you all this example. Pat Bowlen passed away years ago. He left the team in a trust to his kids. There's specific instructions. You had to do X, Y, and Z, this, and this. This many of your siblings had to vote for one person to be the owner, or they have to sell the team and the kids get the money evenly distributed, right? So there was no ifs, ands, or buts in his trust, because he left exactly what happens to a $4 billion franchise or whatever the case is. And they knew exactly what's going to happen. We got actors and stuff we've seen, like Gary Coleman or some of these other people that Michael Jackson didn't have this stuff playing out like he needed to. And people are fighting over money, doing crazy things because the person didn't leave detailed instructions. So again, I would say baseline, wherever everybody's at, get a will right now. Doesn't cost much money. And then as you start getting on track, retirement and, having life insurance policies, having real estate, having a trust is a must at that point.
Okay. All right.
And because I've had a will before, and I have one now actually. But I was kind of confused about, okay, you get it written, or at least we, the one I did was through the military and all that. it was kind of already like pre-written. You just had to answer some questions,
Mm-hmm.
and you get it like what is it called? You get it notarized by a notary. But where's that stuff stored at? Where do you typically store a will at?
That's a great question. So I think what I prepare my clients for a couple of things is like if they pass away, they have their policy, they have my number, and I meet their family. So if this person is to pass away, after you get a call, one of your first 3 calls should be me. Does that make sense? Is what I tell people, because I want to make sure I'm there to actually help the family go through the process. So I would encourage people to do one of 2 things. There's some law firms that do the will and they actually will keep the will at the law firm for you. So they just have to be notarized and they help execute the will. So I have like partnerships with some companies and that's what we do for people. Or, and this is quote unquote old school maybe, but I think people could have maybe it sounds bad. I need to come with a better name for it, but like a jump drive or something that has like your wishes with your death or whatever in it, right?
Okay,
But don't have that where one person can find it and they're, oh, I don't like this, and they throw it away. Have that where like a couple copies or a couple people can have access to it. Something happens to you, so between those people, you know what's going to happen. And then having your paper document somewhere, you can even file it with the city. Here in Colorado Springs, people can file it with the city, have it in the county records or whatever. So when that person passes away, they can go to the county records, pull it out, and nobody can argue about that because it's there. So there's a bunch of different places you could do it, and that's not public record. Like those things aren't public record for people. There's a way you can file it where, if I pass away, you can name a certain amount of people that can come get the access to those documents, and they have a permanent copy on file. So if somebody isn't doing what they're supposed to do, somebody else can go get a copy and say, hey, this is what was actually supposed to be done. But it just needs to be somewhere where somebody you trust, at least 2 or 3 people, I would say. For me, if something happens, obviously my wife's my go-to, but then I have my mom and I have my sister Jazzy. I have a bunch of siblings, but my sister Jazzy, our kids are closer in age. We're closer in age. So if something happened to me and my wife, that's where my kids would go. That's where all the money would go. So she absolutely needs to have access to all those documents.
Got you. All right, man. Listen, that was dope, man. And that was just the intro into
just
planning
get y'all
your financial
primed
future.
and ready. Yeah.
Exactly. Planning your financial future, man. One for you and for your family, man. So this information is vital, man. It's something we need to know, something that's not taught in school, whether that's high school or college. And it's something a lot of our parents don't know, right? So it's good to get it from somewhere. It's good to be if you're in a position, like myself, man, who wasn't privy to this information early on, do that for your family members. If your mom's not listening, your dad's not listening, or people in your family that could benefit from this information right now is not listening, man. You can take it from this interview. This guy, he's super knowledgeable, man. He's been in the game 11 plus years. So if you ain't gonna listen to us, man, definitely listen to him, man. He has skin in the game. All right, man. So yeah, this interview was dope, man. I'm glad you agreed to do it. You taught me a bunch. I'm not gonna lie, you taught me a bunch because I'm not into. I haven't looked into 401ks, 403bs, and pensions, and I've never even crossed my mind to even look into it, man. Because I'm so into the market. Both of us, we're so into the market itself. We don't even think to even look at things like this, man. So you taught us something as well. So I appreciate you for that, man. All right. So for the people who have who may potentially have questions, other than the things that you answered on this interview, where can they reach you at?
Yeah, man. So first of all, I just want to thank y'all brothers for allowing me to be on here. As soon as you sent me the podcast, I started listening, and I was like, man, I love these conversations y'all are having because these are really going to be life-changing conversations that people are really listening and implementing the stuff that you guys are talking about. Inspired me to start. I think I talked to you a little bit, Tyler, like really just me getting back on my fitness, working out stuff. So like that health portion is a big thing. So just listening to you boys talk about that, man, really inspired me a little bit more to get back on it. So I've taken some little steps in the last week. I've taken some little steps, like just make sure I'm walking and doing some stuff.
That's what we're here for, man.
There you go. Changing lives, man. Let's get it.
I definitely appreciate it. But if people have questions that they want to reach out to me specifically, again, like I'm very open. I give everybody my cell phone number, and my phone was ringing the whole time. I put it on silent, but 719-229-2553. If I don't answer immediately, it's because I'm meeting with somebody, but I will get back to you that same day, generally speaking. Or they could email me, MikeWilliams0728@gmail.com, and say, hey, I had a few questions about some of the stuff you were saying. I definitely need some more information. And for everybody that comes to see me through you guys, I will put together a complimentary financial plan for. I will take the time to put that together for them at no cost because y'all fellas sent them. So I would definitely recommend those.
Let's go.
y'all linked in with some people doing some big things. So if you say, hey, Tyler or Daryl sent me, right? I was listening to Uncharted Minds and I heard what you were saying. I was definitely interested in that life, health, and wealth. You mentioned that. I will put your financial plan together complimentary, and I don't mind doing that. So,
hey, love, appreciate that, man. Appreciate that for real.
that was our goal, man. This is our goal, man. This is me and we had a conversation before we even started all this, and it wasn't about notoriety. You know what I mean? Like we're both private people. We don't care about being being famous or right. We're not looking for that, man. We just want to provide game. You know what I mean? And give people, the information that, that they may have been lacking, man. So I'm glad that you were able to do that for us because I was going to ask you to do something like that off camera anyway. So I'm glad you jumped the gun and did that on the show, man. I love that, man. All right, man. Oh, and then social media because, we have a lot of people, we have a lot of our followers, our listeners are, in that social media age group. Do you want to plug in your social medias at all?
I gotta be honest, man. I'm like the old head with social media. I run all this stuff on social media, so a lot of it for me. But people could just find me Michael Williams. There's a bunch of Michael Williams, but at Michael Williams on Facebook. My Twitter is mwills21, MWILLS21. Let me double check to make sure that's accurate. Because I'm telling y'all, I use this.
We'll
stuff,
plug you in, bro. It's all right. If it ain't, we'll just plug you.
Yeah, that's it. MWills21. I believe it's the same on Instagram. So yeah, absolutely, man. Y'all can follow me there. Reach out, send me a message there. However y'all can get a hold of me, just get a hold of me, and I'll definitely take care of you.
Okay, right, man. That's a bet. Hey, go ahead, bro.
Go ahead.
Well, I was going to ask, man. Before we go, we get to the point now where we like to get like a final statement or just a few words of encouragement for our audience, man. So if you have anything for them, man, just spit it and see how they can change their lives, man.
Yeah, man. So a couple things I'll say, and these might sound cliche, but they're very true. What you deal with gets dealt with. What you don't gets worse. So I'm saying that to say, this is stuff that we know we want to do. This is stuff we know we need to do, getting our finances together. So deal with it. So it's done with, right? I would encourage you guys to do that. And then another thing I tell people all the time is, if you don't tell your money where to go, you'll always wonder where it went. So stop wondering where your money went.
Say that about time.
Start telling them where to go. And again, I'm happy to help people do that. And even if you say, hey, Mike was giving knowledge, but I don't feel like his voice, I hated his voice and I don't want to go to him, that's okay. Find something you trust to kind of put this stuff together for you. And I'm just saying, take that first step. But the first step is how you get to the end result, most definitely.
Man, that's dope, man. That's dope. I love this. Hey, man, I hate to keep saying this, bro, but I swear every interview we do is better. I'm not
my favorite one. He better say it.
I'm not gonna say it's better than the last, bro, but it's just I'm like, oh, that's crazy, bro, because I always learn, and I love learning. Man. So anytime I'm taught anything new, I love it, man. So yeah, this is today, one of my favorite interviews, man.
Hey, but that just gotta show, man, like,
I just like learning,
we steadily improving, we steadily learning, man. We just appreciate all the guests that we have on the show, man, because y'all come on and drop so much knowledge and, just impart on us, man. And we just want to transfer that to our audience, you get what I'm saying? Just to transform their lives as well, man. So we greatly appreciate it. Yes, sir.
Exactly. All right, man. So yeah, we're gonna go ahead and close it out, man. I appreciate you again for coming on.
Absolutely.
And this is Uncharted Mind, man. See y'all next time.
Signing off.
Peace.